Edward Yardeni, President of Yardeni Research, joining us this morning. Edward, great to speak with you. Thank you so much
Thank you.
for your time. Pleasure as
Sure.
always. I think we will have to start with a conversation on the latest clouds of war. And this time it's about Iran. How likely do you think there is that we can see a conflagration in Iran? And it doesn't seem like it'll be as quiet as Venezuela.
Well, clearly the risk is very high. When the president moved the Armada at the time close to Venezuela, it was sitting there for several weeks before action was actually taken. So this doesn't, what we're seeing now in Iran doesn't necessarily mean that something's going to happen over the weekend, but clearly you don't put those kind of assets, military assets, close to an adversary without some intention to use them. And it seems as though Trump intends to try to provoke more protests by demonstrating that the United States is ready to assist the protesters.
Yardeni, I wonder whether you think of Iran and the adjoining areas as very differently. That's a logical assumption. But can you explain how you're reading the signs right now? Because you're talking about the entire West Asia region, absolutely crucial in terms of oil production, and the Islamic State currently of Iran. So in the case of Venezuela, though you have those large allies globally, there's relatively less of an impact that we saw at that point. In fact, it went through without anybody saying too much. This would be a different scenario altogether, wouldn't it?
Well, it would be. I mean, already the price of oil has gone up quite a bit. Brent is back up to $70 a barrel. So we've seen certainly a geopolitical risk premium come back into the oil market rather significantly. And Iran does account for a fair amount of oil on the margin. So if things really start to heat up, the price of oil could go still higher, and that could create all sorts of short-term problems, I suppose, maybe in terms of shortages here and there. But you know, the reality is there is a lot of oil in the global market right now. So I think the increase in the price of oil is not necessarily going to lead to supply disruptions in the oil market in the event that Iran is shut off for a bit.
You know, the other, I suppose, aspect, Dr. Yardeni, is the new Fed pick. Whether it's Christopher Waller or any one of the choices that Trump makes, how do you think bonds are going to react? How do you think the street is going to take it? Is there now going to be a question mark over the Fed's independence?
Well, we have seen the bond yield going up here, and I think a lot of that has to do with what's going on in Iran. There is a correlation between the price of oil and bond yields in the United States. Also, we've seen bond yields going up in Japan. With regards to the Fed pick, I mean, Trump is always surprising us almost on a daily basis, and it could be a surprise, and it might be none of the above. I mean, I think he's really wanted to have Secretary of the Treasury Scott Bessent take that job, but I think Bessent just doesn't want to be at the Fed. He enjoys what he's doing at the Treasury. So we'll see how that goes. I mean, Trump certainly values Bessent as Treasury Secretary, but there are 4 candidates, and I think the Fed will perversely actually be more independent as a result of Trump's pick, because whoever he picks is going to be viewed as kind of Trump dependent. You know how the Fed says they're data dependent? Well, I think there'll be some politicization of the Fed chairmanship. And I think other Fed officials who vote collectively for what to do with the interest rates, I think they might actually be a little bit harder to get a consensus with them. And if Trump's Fed chair pushes too hard for rate increases, he could be a dissenter and lose some credibility in that regard. I mean, Powell was very good at creating a consensus, and I don't think that's going to be the case with whoever Trump picks.
All right. Dr. Yardeni, from the perspective of corporate earnings, we've been wondering for some time, and I think we've asked this question before, but the margin,
Sure.
Margin of error for some of these large entities that have gained quite considerably, and you look at Microsoft overnight,
Right.
is very, very small. Would you agree? And do you anticipate that earnings might just come off heading into the new year?
Well, that's not my assessment so far. It looks to me as though, at least for the fourth quarter, we're going to have basically a third quarter in a row where earnings have turned out to be much better than expected, and earnings should be at a record high when the fourth quarter data come out. And I think that'll continue to be the case in the four quarters of 2026, and largely because productivity is making a huge comeback. It may have something to do with AI, but I think companies have recognized that there's a shortage of skilled workers, and they have to augment the skills of their workers by using technology, by increasing their productivity. So I think we've had a earnings-led bull market in the United States, a kind of a earnings melt-up that's caused stock prices to go up, and I think that continues this year. But this year looks like it's going to be also kind of choppy, just the way last year was.
Dr. Yardeni, in a conversation that we had very recently, in fact, Neeraj spoke with you, and the call on gold, at the time people were thinking maybe it might have been a little bullish, but then you blitzed past the level of 5,000. And
I wasn't bullish. I wasn't bullish enough.
You weren't bullish enough. But, where do you see it going? Have you revised your targets even higher, or do you anticipate that there might be a period of consolidation?
Yeah, I don't want to necessarily keep chasing after the price, but I have to be realistic. Let me just turn this off. Sorry about that. I have to be realistic about what's going on here, and it seems as though we have sort of a global melt-up in precious metals, and I think a lot of that has to do with geopolitics. I think from what I hear, Chinese investors are loading up on gold because the reality is they lost a lot of money in the property market. They got whipsawed in the stock market. And here gold looks like it's going only straight up. Whenever I see something going straight up, I get a little nervous that there could be some corrections along the way. And, we've seen the past couple of days that things have been much more balanced in terms of we can see some significant downside, but it doesn't seem to last very long. It seems like buyers come in. When the price of gold got to over 4,000 by the end of last year, got to 4,500. I did raise my target this year from 5,000 to 6,000. I'm going to stick with it, but we're not far away. I mean, a couple of days we could be at 6,000, given how close we are, or we were at 5,500. Now we're somewhat below it at this time. But I'm still using 10,000 as a target by the end of 2029, and that will be consistent with my target of 10,000 for the S&P 500. Gold and the S&P 500 tend to have the same trend. They're inversely correlated, but they tend to have the same trend.
Absolutely. Dr. Yardeni, as always, thanks so much for taking the time. Pleasure speaking.
Thank you.